Congratulations on starting your real estate investment journey. In this section, we'll lay the foundation of your investment strategy, your roadmap to success. Without a clear plan, it's easy to get lost in the sea of opportunities, which is why in these lessons, we're going to cover defining your goals, whether it's cash flow, appreciation, or a balance. Your goals will drive your decisions. Assessing capital, knowing how much you can invest. Choosing an acquisition strategy from traditional financing to creative will select the right one for you. Planning your exit strategy, we'll look at hold and exit strategies to make money while you own your property and how you will ultimately exit from it. Selecting your target location, you'll learn how to choose markets at a high level based on some easy to select definitions. By the end of the section, you'll have a clear strategy that aligns with your goals, risk tolerance, and available capital. This plan will guide you as you begin your search for properties and move closer to financial freedom. All right, let's get started. In this section, we're going to take action. You'll learn the 5 steps to setting your real estate investment goals. And after each lesson, you'll record your answers in the Data-Driven Investor's Action Points sheet. This free resource is designed to help you go from a complete newbie to someone on a clear, focused path to securing your first or next deal. You can find the Action Points sheet in the Materials section, and there's a download link provided in the book as well. The document is broken down into easy-to-follow sections where you'll plan your investment strategy every step of the way. Plus, I've included a pre-filled version as a guide to help you follow along. If you ever get stuck or feel unsure about how to proceed after a lesson, don't worry. You can use the free course GPT to ask questions and get clarification. I've even added helpful prompts at the end of each lesson to guide you in the right direction. And if you've purchased the book, you can also schedule time with me to go over your goals and get personalized advice. More details on how to book that session are in the notes below. I'm so excited for you to start this investment journey and maybe even the start of your financial freedom. I'll see you in the next lesson. Welcome to Lesson 2. Before you dive into property listings or financing options, it's essential to understand how much capital you have to invest. So let's get clear on what's available to you. Capital refers to the total amount of money you will have available for your investment. This most commonly includes cash savings and retirement earnings like a 401k. But how much should you invest from your savings? Let's walk through a quick example. Imagine you have $50,000 saved in your bank account. This may have taken you years of hard sacrifice for living within your means, so congrats if that's so. But now think. Should you invest all $50,000 for your first investment? No. At max, you should invest 85% of your cash savings. Why? Well, you want to keep enough cash on hand for unexpected expenses like repairs or vacancy. So how much do you really need to invest? Is $50,000 even enough? Well, if we look at the median sale price for the U.S., we can see historical values using sources like Fred. And we could see for Q2 of 2024, the median sale price, so what homes are being sold for in this time period across the U.S., is about $412,000. Now, does that mean you need to have $412,000 in order to invest? Luckily, no. Most real estate is financed via loans, meaning you put down cash and you borrow the rest from another entity. Just like if you went to university for your undergrad, you probably didn't pay everything at once. You may have taken loans to be able to finance your education. So say if you are buying a multifamily home, you typically need 25% down. So in this instance, if you're buying a property for $412,000, it would be around $103K that you would need in cash. For single family homes, it's usually 20% down. And if you were living in the property, like via a house hack, is typically 5 to 15% down, depending on how active the current market is. But what if you don't have a lot of cash? Can you still invest in real estate? Yes, you can still invest in real estate. We'll touch on it more in the acquisition lesson of this section. But as a preview, we'll look at alternative and creative strategies to still invest with low money down. So for your action step, go to your Data-Driven Investor's Guide to Real Estate Action Points document and fill out your first box. Log your available capital. Even if you are starting with $1, I want you to enter that into this box. This will help to define your entire investment strategy by the end of this section. So in this example, I just put, I have $15,000 to invest in real estate. That's all I want you to do for now. And as a bonus, you can use the course GPT and the link within the course notes to help guide you through your available capital. See you in the next lesson. Welcome to Lesson 3. Now that you've assessed your available capital, it's time to clarify your investment goals. This will help us to start to define what types of properties will be in scope for your investments. Cash flow versus appreciation. Depending on which strategy you choose as your primary goal will impact your bottom line. So starting with cash flow. Cash flow is immediate income. This is the money that you will see in your bank account every single month. It is your income minus your expenses. For example, if you rent out a property for $2,000 to long-term tenants and have expenses of $1,500 for your mortgage, taxes, insurance, and so on, then your monthly cash flow will be $500, which $500 may not seem like much. But if you acquire one property a year over 5 years, that will amount to $2,500 of monthly cash flow. Maybe not enough to retire, but definitely enough to save for the next property even faster. Imagine the next 5 years, you purchase 10 properties and make $500 cash flow on each. That's an additional $5,000, doubling your progress in the first 5 years, resulting in $7,500 a month in cash flow. Now that's what we call potential financial freedom. If cash flow can put more money in your pocket immediately, then wouldn't that always be the choice? Well, there's also a general downside for higher cash flow. Typically, markets with higher cash flow have properties that appreciate at a slower rate. Typically, properties that have higher cash flow are also older homes. So because of this, they may have more frequent repairs, and that could kill your cash flow. Imagine a CapEx expense like having to replace an entire roof. That could put you out for an entire year of cash flow. And typically, high cash flowing properties are in less desirable neighborhoods. Home prices are low for a reason. How does appreciation differ? Appreciation is for building long-term wealth. It's the change of the property value over time. As an example, imagine you buy a property for $10,000 down. So imagine it's a $100,000 home. You only put 10% down. You sell it at a later period of time for $150K. The property in that time appreciated by 50%. After you recoup your down payment, the money back in your pocket is at least $60,000. Likely even more because you've probably been paying down your loan over time, thus increasing your equity. This is the power of appreciation, turning your $10,000 investment into $60,000 or more. However, appreciation differs by market and by time period. There are also dips that can occur, where your property loses value due to factors out of your control like interest rates. But in the long term, if you hold the property long enough, it will appreciate based on historical trends. So this is truly a long game. So when you decide between cash flow versus appreciation, you need to ask yourself these questions. Do I want steady monthly income to support my current lifestyle or future financial independence? Am I more interested in growing my wealth over time? So maybe I have a job that I like and I don't need to quit anytime soon. So I can hold onto these properties and wait for them to appreciate in value. Now you may be thinking, can I have both? Can I have both cash flow and appreciation? Yes, but only if you hold the property for the long term. You will likely have a lower cash flow to start, but over time, as rents increase, so will your cash flow while you receive appreciation. Or you buy for cash flow, but force appreciation into a distressed property, like redoing a kitchen. Or my favorite, you invest in up and coming areas, markets of high cash flow today, and economic growth that will spur home appreciation. For your action step, go into your Data-Driven Investor's Guide to Real Estate Action Points document and fill out your second box. Define your investment goals. Enter if you want to invest for cash flow or appreciation. Here's an example I have here. I want to invest for cash flow since I am in my mid-30s looking to retire early. My target cash flow is $10,000 a month to replace my W-2 income. If I get 2 properties a year for the next 10 years at $500 cash flow per property, I'll meet my goal of $10,000 a month in monthly cash flow. This is how you get targeted with cash flow versus appreciation and your overall goals. As a bonus, you can use the course GPT in the link to be able to help guide you with your decision. See you in the next lesson. Welcome to Lesson 4. Now that you've defined your capital and set your investment goals, it's time to figure out how you'll actually acquire your properties. Your acquisition strategy is how you'll finance your deals and get started in real estate. Whether you have a large sum of money saved or you're just getting started with limited capital, there's an acquisition strategy that can work for you. First, traditional financing. Traditional financing is securing a mortgage through a bank or financial institution. It's good for predictable loan terms, stable interest rates, and is really easy to understand, which is why a lot of newbies go toward traditional financing to start off with. But the problem here is that it can require a high down payment, usually 20%, and you need to have strong credit. So for example, how this would work, if a property is $300K, with traditional financing, you would need $60,000 to be able to get a loan that would be covered, the rest of it, by a mortgage. Next, FHA financing. Now, this is a strategy I see a lot of newbies take that don't have the capital to be able to invest traditionally. So typically, this is for first-time homebuyers with less capital. So you can put as little as 3.5% down for both single family and at this stage, multifamily as well, which is why it's ideal for those just getting started with limited capital. But there is a caveat. You must live in the property for a year before converting it to a full rental. So for example, if it's a single family home, maybe you house hack where you rent other bedrooms, and after a year, you fully move out and you rent the entire house. Using the same example we had previously, for the property it's $300,000 with FHA financing, you could put as little as almost $11,000 down for a down payment, the rest covered by a mortgage. It's a significant difference that could really help you get started. Next, creative finance, specifically seller financing. In this strategy, the seller essentially acts as the bank. So instead of going to, say, Chase or another bank to get a loan, you are going to finance directly through the homeowner who is the seller. What's great about this strategy is that it can offer flexible terms and often requires less upfront capital. The challenge here is finding a seller willing to finance the deal. There currently is not a platform where sellers raise their hand and say, I want to do seller finance deals. It takes a bit of negotiation and understanding their current circumstance. But this can be a great strategy for those with low credit or in a high interest rate environment to find more cash flowing deals. Next, creative finance subject to. This is where you take over the seller's existing mortgage. So they may have a loan already with Bank of America. They're no longer able to fulfill that loan because of circumstances, and now you're going to take over that loan. What could be great about this strategy is that it can be low to no down payment, depending on the circumstance. It also avoids the need for new financing, also good if you have low credit. But the challenge here is finding a seller willing to do a sub-2 deal. Again, we don't have the circumstance where sellers are raising their hand and saying, I want to do a sub 2 deal. This takes a little bit more of an advanced strategy to use software to find these types of sellers that are in distress. Here's an example. The seller has an outstanding mortgage of $200,000. So they still owe the bank this, but they have a really low interest rate, maybe only 2.5%, whereas the current landscape is 7% for you. So you can take over the payments and assume ownership with this low interest rate. For your action step, go to your Data-Driven Investor's Guide to Real Estate Action Points document and fill out your third box. Choose an acquisition strategy. This will be dependent on how much capital you have available, as well as how active you want to be in your investment acquisition. Here's an example I have here. My main acquisition strategy will be through creative finance, specifically seller financing. I do not have the capital to do a traditional 20% down payment on a property. I do not want to borrow other people's money. My first deal, I'm very risk adverse. I have a fiance and a child, so house hacking is not on the table. I'm okay with putting a bit more work in building relationships to make seller financing my strategy. And as a bonus, you can use the course GPT in the link within the notes to help guide you through your decision. See you in the next lesson. Welcome to Lesson 5. Now that we've covered your capital, goals, and acquisition strategy, it's time to think about how long you plan to hold your properties and how you'll eventually exit the investment. Your hold and exit strategy will influence the types of properties you pursue, the financing you choose, and how you manage your investments over time. Your hold strategy defines how long you plan to keep the property. Are you aiming for short-term gains, or do you want to hold the property for many years to build long-term wealth? If you're holding onto the property, how do you plan to offset expenses and make a profit from it on a regular basis, such as a long-term rental? Your exit strategy defines how you plan to sell or transition out of your investment. Knowing this upfront helps you make decisions about property management and long-term financial planning. There are different types of hold and exit strategies. Let's cover passive versus active. Passive means minimal work to manage the property, and active means a high degree of work to manage or profit from the property. First up, long-term rental strategy. This is where you hold a property for many years, collecting rent and building equity over time. This is ideal for investors looking for steady cash flow and appreciation. So for example, you purchase a rental property and plan to hold it for at least 10 years. During this time, you have 1-year leases and you collect rent to build equity as the mortgage is paid down. The benefit that you get here is also any appreciation in the property value. Medium-term rental strategy involves renting to tenants for a few months at a time, so less than 12 months, often catering to traveling professionals or students. It can offer higher cash flow than long-term rentals with less upkeep of a short-term rental. House hacking is a popular strategy where you live in one part of the property and rent out the other units. This allows you to offset your living expenses while building equity. It's an excellent strategy for first-time investors and one I've done myself. Lease options. Leasing a property to a tenant while granting them the option to purchase it at a predetermined price within a specific time frame. This strategy generates rental income and attracts tenants interested in home ownership. If the tenant moves forward to exercise the option to purchase the property, then you would sell it to them and would hold onto the property for a shorter period of time. This is a bit more advanced, but once in place, it is a very passive strategy. Moving on to active income strategies. With short-term rentals, such as an Airbnb or vacation rental, you aim to generate higher income by renting the property on a nightly or weekly basis. This strategy can be really lucrative in tourist areas, but it does require more hands-on management since you have more people turning out. Then going over to the BRRRR strategy. This allows you to recycle capital. So essentially, you buy distressed property, you rehab it, so you fix it up, you then rent it out, and you refinance it. You then pull that cash to then buy another property. And this strategy helps you scale your portfolio even more quickly. But please note, it is an advanced strategy. In a fix and flip strategy, you buy a distressed property, renovate it, and then sell it for a profit. This is a short-term strategy that requires active management and hands-on involvement in the rehab process. You also are typically managing a contracting team, which if you're very new to fixing up or doing rehabs, this could also be intimidating. So it is suggested to do as an advanced strategy or partner up with someone who's done it before. In wholesaling, you contract a property at a lower price and sell the contract to another investor for a fee. This means you never actually really own the property. You're just the middleman in this scenario. You're finding these undervalued deals to bring forward to investors. Now, if you have $0 to start off in real estate and lots of time on your hands, then this strategy is likely the one for you. So why do you need to know your hold and exit strategy in advance? Well, first, it determines what types of properties you will go after. For example, if you are doing a fix and flip, it would make no sense to purchase a brand new home that has luxury finishes. Instead, you want to filter your buy box to be distressed properties that need work so you can add value to the property. Second, knowing your hold and exit strategy will determine how you finance the properties. In the same example of fix and flip, most of the time you cannot get a traditional loan for 20% like you would for another property. You need to get cash from someone like a hard money lender. This is because the bank will not finance on a risky investment for a property that has deficiencies, making it unlivable in the current condition. Next, the return on your investment. For a long-term rental, 7% cash on cash return could be a good metric to target to find profitable deals. It's a long-term investment that is beating returns from the stock market. However, for an active rental strategy like short-term rentals, 7% is likely too low of an ROI. For the additional risk and management, you want to see higher returns. Also, how the property will be managed will be based on your hold and exit strategy. If you are working full-time in a 9-to-5 job, you likely will not have the time to self-manage a short-term rental. In this case, you need to factor in expenses for hiring a property manager. For your action step, go to your data-driven investor's guide, action points, and fill out your fourth box. Define your hold and exit strategy. This will be dependent on your long-term goals and your risk tolerance. Here's an example of what you may fill out. I plan to long-term rental the properties, at least the first two. After gaining experience as a landlord, I will consider less traditional methods like short-term rentals to speed up my timeline to financial freedom. And as a bonus, you can use the course GPT in the link within the course notes to help guide you through your decision. See you in the next lesson. Welcome to Lesson 6. Now that you've figured out your capital, set your goals, and chosen an acquisition strategy, it's time to focus on location. In real estate, location isn't just important, it is everything. The market you invest in will directly impact your success from cash flow to appreciation. So selecting the right location is crucial for your investment strategy. So why does it matter? Why do we care about location? Well, investments like stocks are liquid, so you can buy them and sell them almost instantly. But you can't do the same for a property. It is illiquid and immobile. You marry the land as much as the property when you make a purchase. We are going to cover 3 topics to consider for determining your high-level location strategy: local versus out of state, landlord-friendly versus not, and high versus low climate risk. Starting with investing locally versus out of state. Local investing means focusing on properties within about a 2-hour radius of where you live. This strategy is ideal for new investors who want to stay close to their properties and leverage their knowledge of the local market. Another benefit is managing the property. Living nearby typically means you can handle property management all by yourself, cutting down on costs like hiring a property manager. One of the biggest cons, however, with investing locally is that you may be priced out. If you live in a market like San Francisco or New York City, you are likely in an area with high property prices that may be out of your budget. For investing out of state or long distance investing, it allows you to take advantage of markets that might have growth potential or be more affordable than your area. As well, you have the opportunity to tap into a larger investing network. For example, if you live in Connecticut and maybe you want to invest in a small town there may not be as many property managers, contractors, or even fellow investors that are also on the same path of trying to achieve financial freedom. But if you look in large markets, like say Phoenix, Arizona, that have a booming presence of investors, you could likely expand your network even faster, connect with more agents, more contractors, property managers, and even people to partner with on deals. However, a big drawback of investing out of state is that you have less control of your investment. You won't have the same hands-on control of the property, like driving through it or being there frequently to make repairs yourself. So you likely will have a local management team to handle your day-to-day operations. It is an added expense, but one that can be justified because you may be receiving higher cash flow. When deciding where to invest, it's essential to consider whether a state or city has landlord-friendly or non-landlord-friendly laws. Now, you can invest in either or, but for some people, they really only prefer landlord-friendly states. So landlord-friendly states tend to favor property owners and investors. This makes it easier to manage properties, enforce leases, and protect your income from rental properties. So for example, Texas is a great landlord-friendly state. Their eviction process is pretty streamlined. Landlords can remove non-paying tenants relatively quickly, typically within a month. There's also no rent control, which allows landlords to raise rents in response to market conditions. Also, landlords can access tenant information, for example, criminal records during a screening process. This can overall help with the safety of a neighborhood, be able to have capitalism of being able to control how much you can actually raise your rents. And if someone's not paying, right? If say they went to a store and just took a t-shirt and didn't pay, that's not allowed. So why should it be allowed to not be able to pay rent? This is one of the major reasons why people only stick with landlord-friendly states. But on the flip side, you can also still invest in these non-landlord-friendly states. They favor tenants. For example, New York is a non-landlord-friendly state. The eviction process can take very, very long time, like months or even through extenuating circumstances, even years. New York has strict rent control and stabilization laws as well, meaning that landlords can only raise rents a certain amount per year, limiting income growth for property owners. As well, there is restricted access to criminal records. You cannot typically use criminal records to screen a tenant and can only use eviction records, which makes it a little bit more difficult when you're trying to see who may be the most optimal tenant for your property. Moving on to climate risk. Properties in areas with a high risk of natural disasters can come with higher insurance costs. So that's what we mean by climate risk. Think of hurricanes, floods, wildfires, or earthquakes. Think also as Florida, prime example of high climate risk, has a high exposure to hurricanes and flooding. For example, many areas in Florida are designated flood zones requiring additional flood insurance. This can significantly increase expenses, as well as any repairs that may come from natural disasters like hurricanes. Well, you may be thinking, why would anyone ever want to invest in Florida if there's a high likelihood of having these natural disasters? Well, depending on the type of property you have, for example, a new build in an area that's farther from the coast, you may not see these effects as much. As well, these types of areas do have high appreciation and a large population of folks moving in. So it can still be desirable, but you need to know if you are willing to take those risks. Now, for low climate risk areas, the likelihood of natural disasters is lower. So less chance of property damage coming from natural disasters, and thus lower insurance premiums, so lower expenses. An example of a state would be Ohio. Ohio has low climate risk, so you have lower insurance costs than other states like Florida or California, fewer natural disasters, so arguably more stable environment, and you could see long-term. While low climate risk areas like Ohio may not offer the dramatic appreciation seen in some high risk markets, they do provide a peace of mind and can provide predictable returns. So it's really dependent on your risk tolerance. For your action step, go to the Data Driven Investor's Guide to Real Estate Action Points and fill in the last box here for this section. Define your location strategy. This will be dependent on your long-term goals and risk tolerance. We will also cover location more in depth for market and neighborhood analysis in the next section. But here's an example of what you may write in your notes. Although I live in an expensive market, New Jersey, I want to invest locally to have more control of my investments. I will likely need to find properties slightly distressed for affordability and cash flow. I am not handy, but I am confident I can find people in my network that are. I am okay with investing in the Northeast, although it is not landlord friendly. Investing locally is my main priority. I am okay with investing in a harsh winter climate. I will be mindful to consider flooding and shoveling difficulty when looking at properties later. And as a bonus, you can use the course GPT in the link within the course notes to help guide you through your decision. See you in the next lesson. Congratulations on completing section 1 of the course. You've now built a solid foundation that you can refer to in later sections for your personalized investment strategy. This is a huge step that many investors skip. However, it will keep you focused on your goals and ultimately your decision making. Let's quickly recap what you've been able to accomplish in this section. You defined your investment goals, whether it's generating cash flow, appreciation, or a combination of both. You've assessed your available capital and chosen an acquisition strategy that fits for you. You've also decided on your hold or exit strategy to make income and ultimately profit exit from the property. By taking the time to create a well thought out strategy, you're already ahead than most investors. You've set the stage for smart, informed decision making, and now it's time to actually take that knowledge and apply it for market research. In the upcoming section, we'll dive into how to choose the right markets and neighborhoods for your investments using data. Great work so far, and I can't wait to see you in section 2. If you found this helpful, I've got an exclusive offer for you. When you grab my new book, The Data Driven Investor's Guide to Real Estate, you'll get free access to the full course, but only for a limited time. This course dives even deeper into what we cover here, so click the link below to grab your copy and start closing deals in the next 30 days.